Better System Trader, episode 61.
Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Welcome to the Better System Trader podcast. This is episode 61, and I'm your host, Andrew Swanscott. There are a number of different aspects to trading that we really need to get a handle on to increase our odds of success. Some aspects we often put a lot of thought and analysis into, and others, well, we may not consider so carefully or even at all, which could be impacting our trading results without us even realizing. Today's guest, Dr. Howard Bandy, is here to discuss the foundations of trading, and some of these aspects we really need to consider, whether we're just starting out or a more experienced trader. Howard has over 50 years' experience in the research and application of modelling and simulation of financial systems. He has previously worked as a senior research analyst for a CTA firm, is a consultant to trading companies and individuals, as well as being an international speaker and publishing a number of books on quantitative trading systems. In our chat today, you will hear how to choose the right markets to fit your risk profile, trading style, and objectives, the 3 characteristics a market must have to be tradable, the difference between impulse signals and state signals and how they can be used to manage trades and monitor trade health, the 4 parameters you need to understand to define your own risk tolerance, and choosing the best objective function to evaluate trading strategy performance. But before we get to the chat with Howard, a quick word from our sponsor, Alvarez Quant Trading. Do you want to expand your knowledge of Amy Broker quickly, but don't know how? Why not learn from someone who's been programming in Amy Broker for over 15 years? Alvarez Quant Trading provides beginner and intermediate courses in backtesting with Amy Broker, and for a very limited time you can secure a huge discount, so act now. Head over to the show notes page at bettersystemtrader.com/61 for more info. And now on to our chat with Dr. Howard Bandy on the foundations of trading. Hope you enjoy it. Hi Howard, thanks for joining us today.
Well, thanks for having me, Andrew.
It's really great to have you here on the show again. I think the last time you were a guest on the podcast was for episode 6, which was way back in May 2015, so it has been a while. And I think back then you just released your quantitative technical analysis book, perhaps a few months before that, which I think was that your 5th book?
That was number 5.
Yeah, right, yeah.
And then in August of this year is Foundations of Trading, which is what I describe as the Cliff Notes version of the Quantitative Technical Analysis book.
Yeah, okay, great. So that's why I've invited you here today, so we can have a bit of a chat about that book. As you mentioned, it's called Foundations of Trading, Developing Profitable Trading Systems Using Scientific Techniques. So how about, to get us started, can you just give us a brief introduction to the book and what it covers?
Yes, thanks. The book is intentionally short. It's about 168 pages long and intentionally inexpensive. The paper copy is about $16 if you buy it from Amazon, and the ebook is available from Amazon. It's either free or about $3, depending on how your Amazon account is set up. My intention is to distribute the information widely as an educational project. The book begins with a little bit of history and talks quickly about trading system development, makes the distinction between the trading system and the trading management system, and the connection between the two being the set of trades that I've described as the best estimate set of trades during development and then real live trades during trading.
Yep.
And I talk about development in several ways. One of the things that's happened recently, it's happening very, very quickly, is the transition from traditional trading system development platforms such as TradeStation and AmiBroker to machine learning. And an increasingly large percentage of trades are being made by algorithms, many of them run by serious trading houses, Jim Simon, Goldman Sachs, and so forth. So one of the points that I make is that all of us who are trading are in the same arena, that there isn't an opportunity to have a do-over or there isn't an opportunity to have a do-over or a mulligan, and we can't get a tournament that gives us a handicap if we're just getting started. So in order to be competitive, traders as individuals or as small companies need to have the same skills and the same equipment and the same techniques as the people they're trading against. So the Foundations of Trading is an attempt to lay out what some of that basis is and do it in a very concise manner. There's no code. There's similarly no smoke, no mirrors, no hand waving. It's exactly what works.
Yeah.
I begin with a little background about technical analysis, and from there go quite quickly into trading system development itself, and draw the distinction between the traditional platform and the machine learning platform. And one of the differences that any one of us can use, whether we're using machine learning or trading system development platforms, there's a big advantage in switching from impulse signals for trades to state signals for trades. And early on in our talk today, I want to describe what that is.
Great, because that's one of the points that actually caught my eye. So I'd love to have a chat about that with you.
Okay.
As you mentioned, you made a distinction between trading signals being either impulse or state. So perhaps you can share the difference between the two and where you might see each of these type of signals.
Yes. Impulse signals are signals that happen one time on one bar and then typically not again until there's another critical event. And the critical event might be something like a cross of moving averages or an indicator rising or dropping through a particular level that's being used as an indicator level to create a buy or a sell signal. The buy is an impulse, and that initiates a trade, and then while the trade is being held, there are no signals at all. Eventually, there's a sell signal, and that occurs just on one bar, and then the system is either flat or, if it goes short from that point on. The ends of the trade are marked by the impulse signals buy and sell. State signals exist for every bar or every day that's being evaluated. So if we were using state signals, we might define that there are three different states, long, flat, and short. And I might define a state signal as B long, B-E-L-O-N-G, B long, B flat, B short. And while I'm flat, every day I look at my system, I'm going to have a state that is to be flat. And as soon as there's a buy signal, that gives me a B long state. And from that point until there's a sell signal, we just repeat the state we've been in until it changes. The advantage is if I've got, for example, a trade that starts on Monday and closes on Thursday, I've got Tuesday, Wednesday, Thursday as a 3-day trade. If there are impulses, that whole thing is one trade. If there are states, I've got 3 individual 1-day trades that from an accounting perspective look the same. But there's a big advantage as we're doing trading system development. One is we're focused on our trade every day, and our system is giving us a signal every day. The other is, as we're doing validation, the only trades that are usable in validation are those that are both opened and closed in the same evaluation period. If an evaluation period is, say, 6 months, there might be a few week or 2 week long trades in it, but there would be 126 state signals in it. And each one of those gives an opportunity to do an evaluation, a management if that's required, and each of those trades, since it has a one-day return on it, is usable in the validation process. Mm. If we're coming to trading system development from a traditional platform, we'd probably come in through the impulse. We see a buy signal, and then we hold a trade, and then we see a sell signal. If we come into trading system development from machine learning, the state signal is associated with the target for the supervised learning. So people who are coming in from machine learning already know about state signals. Anyone who's using an impulse signal can translate those to a state signal pretty easily. Let the impulse signal happen, and on the first buy, set the state to be long, and then just copy the previous day's state until you see a change. So it works for someone who's using AmiBroker or TradeStation or Ninja, a traditional development system as well.
Yeah, well, so it sounds like they're kind of interlinked though, because I think if you look at how trading logic is traditionally formed, isn't an impulse signal really just the output of a combination of state signals?
An impulse signal is usually recognition of some condition. It depends on how the trading system rules and logic are set up. But if it's if the trading system says buy when the 5-day moving average crosses the 10-day moving average, it hasn't been tracking the state. It looks for that particular pattern, the cross of those two moving averages, and issues an impulse signal on that bar, and then it goes quiet again until it sees one of the other critical events. So traditionally, the buy and the sell have come to technical analysis through the historical development of technical analysis, chart patterns, looking for divergences, looking for breakouts, and those become features of the development platform.
So it sounds to me like state signal is probably a better approach, because it kind of changes the way you're viewing the trades. And you've already touched on a little bit of the benefits of using state signals, but can you expand on that a bit more? Like what are the applications that for this type of approach in trading?
Well, their development goes on in a couple of different stages. One of the stages is thinking up ideas that might recognize profitable patterns, and following that, developing some sort of rules or some formula that looks for that pattern, recognizes it, and gives the impulse signal. So the state signal gives us an opportunity and really a requirement once we decide to use it, to look at each day by day, and focus on what are the conditions today and what do we want them to be from this particular point until the same point in time, usually tomorrow. And it gives us an opportunity to evaluate daily, and it gives us an opportunity to evaluate the trading daily, and it gives us an opportunity to put more data points into the validation. After the backtesting, we know that something worked well during the trading data, but we don't know whether it's going to work in the future. So looking at the training data alone is not adequate. The in-sample data, as it's called, doesn't give us much of an indication of whether the system is going to be profitable in the future. What we need for that is validation, and the validation is typically done with something like a walk-forward process, where we adjust the system over the training data, the in-sample data, and then evaluate it using the parameters that were chosen in-sample by looking at data that hadn't been seen before, the out-of-sample data. And the state signals give us an opportunity to have a data point for every day in the evaluation period, perhaps leaving off the one at the very end and the very beginning. And that's quite a bit different than impulse signals, where we can only use trades that are complete within the evaluation period. The systems, two systems, trading system and trading management system, are combined through the best estimate set of trades, and those become the basis for the data that's fed into the trading management system. And the trading management system can use that same data to estimate system health and determine the best position score. So the state signals have a benefit as we're looking at trading and managing the trades as well. They allow us to focus every day, and we get a new state signal every day. So if our system starts to become unhealthy, we get a notification of it right away.
Yeah. All right, thank you very much for explaining that, Howard. I think people can see that there's a lot of benefits to using a state signaled approach. So thank you very much for that. Now, I'd just like to switch topics a little bit now to market selection, which is a decision that traders of all levels have to make, whether you're a beginner just starting out or an experienced trader looking to diversify into other markets. And I think sometimes market selection is really made based on perhaps convenience or account size. And I think your book really raised some interesting points on market selection and the type of thought or analysis that we really need to make when selecting a market or perhaps markets. But firstly, can you share why is it important to really put some careful consideration into choosing an appropriate market?
Yes. I'll do the elevator speech first, and it won't have a whole lot of background, and then I'll go back and fill in the blanks.
Yeah, sure.
The data series that we trade, even before we apply a set of rules, the rules come in the model, the data and the model together become a trading system. Even before we do the system part, the data itself must have three characteristics. One of them is it has to have enough volatility. One of them is it has to have enough volatility so that there is profit potential. If there's something that changes very little, it might be safe to trade, but it won't be worthwhile because there's no profit potential. And very often, data series like that don't give an opportunity to use leverage to ramp up the profit potential. On the other hand, we don't want so much volatility that even short holding periods can create whipsaws and raise the risk. So we need enough volatility, but not too much volatility. It's kind of like Goldilocks and the Three Bears. You want to have porridge that's not too hot and not too cold. Yeah. And given that you've got a data series that has the right amount of volatility, then it has to have patterns that precede profitable trades, and we have to be able to identify and recognize those patterns. So a data series, in order to be tradable, needs those three characteristics. Some volatility, but not too much, and patterns. The volatility measurements go back to risk, and one of the things that I've done is analyzed the risk in any series of data it's easiest to describe in terms of the risk associated with a series of trades, where we can look at the mathematical concept of the distribution of a series of trades. And we hope one of the tenets of technical analysis tells us that the future will resemble the past. And if that's the case, then there's a chance that the work that we've done in developing a system using backtest data will carry forward into the future. That concept is called stationarity. It's really important. I've done a video presentation and posted it to YouTube, and I recommend that people go to the Blue Owl Press website and click on video presentations and watch that.
Yeah, I think actually, Howard, we discussed stationarity a little bit in the previous podcast episode, but can you just give us a quick little explanation of what that is again?
Okay, stationarity is with respect to some particular metric, and it's with respect to a distribution. The metric that we're looking at is signals that precede profitable trades. So if we see some pattern that a certain pattern of the data regularly precedes by as little as one day a profitable trading opportunity, we want those same conditions to be carried forward into the future that they have been in the data we're using to develop the rules. So stationarity in that regard is that the future resembles the past. Excuse me. What we're doing when we analyze the risk is we're looking at the distribution of a set of trades, and we're saying if the distribution is the same in the future, then we can estimate what the risk will be. The best we can hope for is that the distribution's the same. There are the same number of winners, the same number of losers, the same holding periods, and so forth, just generally. But the one thing we cannot anticipate, that we cannot count on, is the order of them. So there's a Monte Carlo process that's used to estimate what the distribution of the risk and the profit would be. And we can apply that to trades. And interestingly, we can apply that to the data series itself before there's a trading system that generates the trades for it. And I go through that in the quantitative technical analysis book, and I also go through it in the Foundations of Trading book.
So I guess the first part of that process, though, is to try and understand your own personal risk tolerance. And then, as you mentioned, you can go through a Monte Carlo process on the data itself to get a better understanding if the profit potential and the the risks in that data series match your own personal risk tolerance. Is that basically what you're saying there?
It is, and the risk tolerance, everybody has one. The experience I have and those of people I work with is that trading systems are great until there's a series of losses and people stop trading because they have a drawdown, a loss in their trading account that's greater than their tolerance. And they typically don't have rules for getting out of that gracefully. So it tends to be go along well and experience a bad patch and then stop trading. And what I've discovered, and some of it is some unique original metrics, is that if we do position sizing in the trading management part, we can look at recent performance, and as trades are good, as they're profitable, as we've got a high percentage of winners and a high amount won on each trade, the system is well synchronized with the data, and we can trade confidently and we can trade larger. The position size can be bigger. And then as there are losses, either an increased portion of losses or large losses, the risk increases and we should cut back on the position size. We can start by each stating our own personal risk tolerance. And let me state mine and the one I use in the book. It's got 4 parameters in it. I say I'm trading a $100,000 account. I'm looking forward 2 years. I want to hold drawdowns. That's the loss from the highest equity to date to a maximum of 20%. And I'm willing to take a 5% risk of a loss greater than 20%. So the 4 parameters are $100,000, 2 years, 20%, and 5%. And if you look at the chart on the front cover of the Foundations book, you'll see that particular risk tolerance statement plotted. But it's possible to make it well quantified, and we can measure the risk of any set of trades against that statement. And if the risk is higher, that means we need to have a lower position size. And if the risk of those sets of trades is lower, that means that we can be more aggressive and increase our position size. So the metric that's involved there is called risk normalization. We start out by comparing the risk of a trading system with the personal risk tolerance, and then adjust position size to a level that I describe as SAFE-F, SAFE-F, the safe fraction of the account that can be used for the next trade without the probability of a drawdown exceeding the person's risk tolerance. And then given risk normalization, we can compare what's the profit is likely to be, and we can come up with a distribution for profit as well. And we can pick a particular point on that distribution curve and identify it on all of the things we're considering comparing. I call that CAR25, CAR25, and it's the compound annual rate of return of the distribution of profit. So given normalized risk, we really don't need to do anything other than pick the alternative use of our money that has the highest CAR25 and just trade it. We don't need a portfolio. We don't need a large number of alternatives. Just pick one and manage it. And when it is no longer the best performing CAR25, switch to whichever one it is. That also means you can use that as a regime switch metric.
Okay, we're going to take a very short break here for a quick message from our sponsor. And then right after that, Howard is going to tell us how we can use a quant approach to determine the best type of trading style and time frame for a particular market. So we'll hear all about that in just a sec. Do you want to expand your knowledge of Amy Broker quickly, but don't know how? Stop wasting time trying to figure it out for yourself and learn how to do it properly from someone who's been programming in Amy Broker for over 15 years. Alvarez Quant Trading provides both beginner and intermediate courses in Amy Broker and backtesting, where you can start with absolutely no programming experience and quickly learn how to create and validate your very own trading strategies, adding stops and implementing market timing techniques. The intermediate course covers more advanced topics like custom charts, indicators and reports, multiple timeframes, scaling in and out, and the correct use of optimization. But that's not all. As part of the course, you'll also get full email and Skype access to Cesar Alvarez to make sure all of your questions about Amy Broker and backtesting are covered. So end your frustration of not knowing how to use Amy Broker properly and take a look at the courses available from Alvarez Quant Trading. Plus, if you act right now, you can secure a huge discount off either course. So, for more information, check out the show notes page at bettersystemtrader.com/61. And now let's head back to our chat with Howard. If I can just jump back to the a bit earlier when you were talking about the Monte Carlo process of analysing the market data series to determine things like profit potential and risk, it sounds like that type of analysis could also help direct you towards a trading style and time frame. So what have you found to be the case when doing that type of analysis on the markets? How does that kind of lead you into the trading style that might be most appropriate?
Yes, I'm not sure I completely answered earlier when we were doing issue selection, but these two are very closely tied together. We can take a data series and we can make an assumption that we're going to be a certain amount accurate. For example, anytime we throw a dart at the data series that with 65% probability we're going to start a winning trade, and we can look at how long we're going to hold it. And we can do a series of analyses of that type and say, if I am 65% profitable and I hold 3 days with a particular data series such as the American SPY or Broken Hills, whatever, it works with any data series, we can analyze what the risk and profit potential is for any individual data series that we might trade, and we can rank them. So we can do the risk analysis on the data and use that as a selection for the market to trade. And then as we're trading, the Monte Carlo analysis lets us give an estimate of what's going on during trading. So the Monte Carlo analysis comes in two places, first in issue selection, and then in managing a trade and estimating what the risk and profit potential is going to be over the period of the lifetime of the trading system.
All right, thanks, Howard. Now, you just mentioned CAR25 before as a kind of an objective function. How does a trader actually decide, though, which objective function is best for them?
Well, CAR25 is as universal an objective function as I have found. And there are some important characteristics of objective functions. The objective function needs to do two things. Each alternative, and that's a different set of combinations for a particular trading system or a different set of markets for a given model or any alternative way of using your money in your trading account, or depending on what else you're considering doing with the money, perhaps including that as well. All of the alternatives need to be ranked in some way so that we can pick which one we want. And the objective function is associated with the results from applying some set of rules to some set of data. We get a risk, we get a position size, we get a profit potential, and if the risk is normalized, the profit potential is the CAR25 metric, and since all the risk is the same, we can use CAR25 as an objective function that lets us select. One of the things it does as well is if we've got several things like the results from two different sets of moving average crossovers, we can look at the CAR25 or other metric associated with each of those test results, and if we've got a subjective preference for one or the other, the objective function values should be in agreement with our subjective preference. So the objective function acts as a preference and it acts as a comparison. And additionally, as we're going through the validation procedure and using the walk-forward process, the objective function is computed for each of the alternatives in the optimization, and the in-sample, the training data, is evaluated using the objective function, and those alternatives are ranked. And the top one is the single one, the only one that's used to test the out-of-sample data that follows. So the objective function needs to be good at identifying trading system alternatives that carry forward well, that learn well in the machine learning terminology.
Yeah. Okay, thanks, Howard. Now, I think at the start I actually cut you off from describing the rest of your book, so sorry about that. But how about, can you perhaps, your book covers a lot of different aspects of trading and developing trading systems. So what do you think are some of the most important points or key takeaways from the book?
One of the things I've found is that in order to be successful, there's what I describe as a mantra. And the mantra is trade frequently, trade accurately, hold a very short period of time, and avoid losses. That's not to say that you can't be profitable trading if you vary from one or more of those. What it does say is that if we've got those characteristics, then we probably have a situation where we've got low risk and high profit potential. And the further we get away from those, the higher the risk and the lower the profit potential, to the point where, in my experience, the markets have become so efficient and the competition is so fierce and it is using such good tools that everybody who's trading is forced into the same trading environment that they just short of high-frequency traders are using. If we look at what Jim Simons is doing, for example, in his hedge fund, and he's using machine learning mathematical techniques, it's trade accurately, 65% or better, hold a short period of time, 1 or 2 days at the most, trade frequently, 20, 30, 40 long positions each year, and avoid losses, avoid large losses and avoid high percentage losses. But the result of that is that when you're looking at trading system indicators that fit that mantra, all of the indicators look alike. It doesn't matter which one you use. I recommend that you pick the RSI indicator and that you look at look-back periods that are from 1.5 days to 4 days in steps of about a quarter of a day. And if you compare that with detrended price oscillator or other indicators, you'll find that it doesn't matter which one you use. By slightly adjusting the look-back period or the critical level to give yourself a signal, that they are essentially equivalent. My point there is that trading is moving to shorter holding periods, more frequent trading, and the requirement of being more accurate.
I think actually in a previous podcast interview you mentioned, you kind of mentioned it a little bit earlier as well, that the competition is the Goldman Sachs and those kind of players that have a lot of money, a lot of resources, a lot of smart people working on the markets, and a lot of people can't kind of compete at that level. So do you think it's best to try and use those techniques, or is it better to look elsewhere? Like how can we compete with people like that?
Well, one of the things I mentioned earlier was that we only get one opportunity. We all have to compete in the same market. When I buy SPY, it may well be Goldman Sachs who's selling it, and one of us is right and the other one's wrong. And I don't get an opportunity to trade against my not very bright brother-in-law. So I have to be prepared to compete in the main arena. That means I need to know some math. I need to know some programming. I need to have pretty high quality equipment, and I need to have systems that I can count on and I need to have metrics that tell me when they're working and when they aren't. And the purpose of the Foundations book is to lay out the foundations of what works and what doesn't. It's not to say that if you violate any of these that you're going to go broke, but it's going to be much more difficult to find a profitable system, particularly once you're trading against people with those sorts of skills and support. So it really is the Malcolm Gladwell's 10,000 hours to be good at anything. That applies. And I recommend that people learn the math and learn the programming. That it's a requirement. I get phone calls and emails a couple of times a month by somebody who wants to hire me, and my somewhat sloppy way of describing what they want is they're hoping that I can send them a short file that contains a trading system and they will be rich by Wednesday. And it won't happen. Let me make one recommendation. So there's a book that I recommend that everybody who wants to be a trader read. It's not a trading book. The author is Daniel Kahneman, Kahneman, and his book is Thinking Fast and Slow. Yeah. Kahneman's a Nobel Prize-winning economist, and he comes to his conclusions based on a lot of research. One of the things he points out just beautifully to me is the number of ways we fool ourselves. And anytime somebody's interested in doing a trading system that is not 100% rule-based, I recommend that they go back and read Daniel Kahneman again. That it's pretty well proven now that well-designed algorithms are better at making choices than even expert subjective decision makers. So in order to be successful, we really do need to be quantitative analysts, and we need to be using the best techniques.
Yeah, that's some great points there. Thank you very much, Howard, for sharing that with us. So I'd just like to start wrapping up now. Is there anything else that you'd like to mention before we finish up?
Nope.
Okay, fantastic. Well, I think you've done a great job with the Foundations of Trading book. It's not just for beginners, but there's a lot of great content in there, and it's jam-packed with a lot of stuff in a small book. And as you mentioned earlier, it's very cheap, so I recommend people should go and check out that book. Now, you've also kindly offered a couple for us to give away, so I'll have some information on that on the show notes page as well if people would like to have a chance at winning one of your books. Thank you very much for spending time with us today and discussing some of the stuff that we had a chat about, and I wish you all the best.
Well, thank you very much. It's always a pleasure, and I regularly listen to the interviews that you've done. I think you're doing a great service.
Excellent. All right. Well, thanks a lot, Howard. I'll catch you soon.
Thanks. Take care, Andrew.
Okay, bye. Okay, a big thanks to Howard for taking the time to chat with us about the Foundations of Trading today. As we mentioned towards the end of the chat, Howard has kindly provided 2 copies of his new Foundations of Trading book to give away, so if you'd like a chance to win a free copy of the book, then head on over to bettersystemtrader.com/61 to get more details. And if you can't wait and you prefer to buy a copy, we have a link to the book on the show notes page as well, so go check that out. Anyway, that's it for this episode. We hope you enjoyed the chat with Howard, and I look forward to catching you at the next one. Thanks for listening to Better System Trader.
Thanks for listening to the Better System Trader podcast. The next step is to head over to bettersystemtrader.com for more expert tips, practical advice, and exclusive content. Catch us next time for even more great ways to improve your trading here on Better System Trader.